relax, flocks together. You already know what the business is. Welcome back to another episode of Big Talk Live. That's right. This is Big Talk Live, where we talk about big ideas, big goals, and big vision. In this episode, we'll be talking about, man, how do people use other people's money to become rich and wealthy, right? How to use OPM. There's good debt and then there's bad debt. And some secrets, 5 secrets of how banks work and what do they do with your money. And especially during this banking crisis, we got to know about this stuff and how to have a financial plan for the future. Are you planning or are you just reacting? A lot of people are just reacting. Are you proactively planning? See, you don't get to success accidentally. You get to success by having a financial plan. So, all that coming and more. So, stay tuned. Give you guys a few seconds to jump on in, okay?
Eastern Side Beats. Eastern Side Beats.
Yo, I am super excited about today's episode. We'll be talking about some really huge, important topics right now, and the topic of money, how banks work, and how to have a better financial plan. So, trying something different here, and I hope you guys enjoy this. I will encourage you if you like some of the like some of the stuff we're talking about, comment, like, share, and please tell other people about this. You know what I mean? And let me know how this episode goes because I'm super excited to talk about this. You guys, a lot of people needs to understand how banks work. A lot of people need to understand how to use other people's money, how to use good debt and bad debt. See, truly rich people, they're not wealthy because of the money they have. No, 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 no. They're rich because they can make the money back if they lose it. That's right. A lot of millionaires and billionaires, they have experienced like situations where they were almost completely wiped out. I know a few people actually was almost completely wiped out. But for many billionaires, they know how to get back. They know how to make lose their first million, lose their $4 million, and come back and make another million and another million, right? So for a lot of people, actually, mostly billionaires, their net worth is either $17 billion or -2 billion. You see, they either have billions or they have or $1 billion in debt, and there's no middle ground. In a lot of cases, it's pretty much they exist at the same time. So I want you guys to understand the reality of fiat money, right? Money has evolved over the years, and right now it's just a piece of paper with some type of like constituted authority. See, currency is nothing more than a debt certificate. That's right. It's just an IOU. See, in 1971, the American dollar was detached from gold. And a few years before that, the whole world had pegged their currencies to the US dollar in the Bretton Woods Agreement. So since 1971, the value of the United States dollar has always continued to get devalued. That is, of course, spreads to other currencies in the world. And this is because all international transactions are settled in the United States dollar at the Bank of International Settlement. All right. So the United States government and the Federal Reserve, which is actually the central bank in America, they determine that the value of the United States dollar through monetary policies and spending habits. And the value of money has consistently gone down. And a lot of people are upset about this because maybe they didn't get the memo, whatever it is. And but you know what? It's very straightforward and it's also uncomfortable. But long story short, the problem is that savers become losers. If you're saving your money, you're actually losing money. Why? Because inflation rate goes higher and higher, and borrowers are rewarded. So the problem is not the change in the system. And matter of fact, it's just because no one got the memo, right? A lot of people don't understand it, and most people they will never will, right? Today's millionaires right now, they keep their wealth in assets and they take loans against it. They rarely keep raw cash. The only time they keep raw cash is when the central bank goes on some type of massive rate hikes, like today maybe. And that raw cash is actually often always borrowed money because they got it at low rates. So they're always using other people's money, OPM. And you have to understand this. This is the game. You know, um, I heard like a businessman, he borrowed $300 million in 2008, and he was actually able to buy tons of assets on the cheap during the financial crash. And then in 2020, the same businessman borrowed $1 billion and he's doing the same thing. And this is the reality of the money game. But nobody taught us in, this in school. Nobody teaches this in school. So you're probably wondering, why did the bank keep giving him money? Well, the banks, how they operate. See, banks give money like that because that's their business. Banks make money from loans and they want good loans. Bad loans are what makes banks fail. See, this businessman, he's been a good source of business for the banks. The loans he took in the past were always net positive for the bank. And not just that, he have collateral. You see, you gotta have make the money, keep more of what you earn, grow it, and then leverage it as collateral. So he has to guarantee banks that the bank's looking for. So why not? And then the question becomes, so why has he qualified to get the loan? How did he get the things he could use as collateral? Well, he built things. He built businesses. He built assets. That's the main point because he has a track record of building things. He can keep getting money from the bank to fund his next business ventures. And that makes sense, right? This is why the rich keeps getting richer. It's very hard for the poor to get rich because, I mean, the poor cannot be trusted to build anything. The money you give to the poor, it just disappears, it evaporates. But it's different for the rich. It's as simple as it gets. It doesn't get any simpler than that. You know what I mean? You are valued financially by what you can build. And people believe what you can build by what you have built. See, the custodians of currency are primarily banks and investors, and they judge a person financially by what they have built. So you're not rich because of what you can buy. You're rich because of what you can build. What can you do with the money? And how do I know that you can come back with the money? Right? You're rich because of what you can build. And when the great builders, when they retire, and investors and banks, they lure them back with offers to get them back in the game. Right? You always want to have your money with someone who can build things. You want someone who can build things that are valued beyond what they spent. So therefore, guys, what makes you rich? It's not what you have in your bank account at one time. It's actually how fast can you get money from financial institutions when you want it. That's super important. So if you want to become rich, my advice, start from scratch. Start today. Start looking, developing in yourself, investing into yourself, and build something. Because when you build something, banks are more likely to lend you money. You got to use OPM. And if you want to learn more how to become your own private bank, how to invest like a bank, how to not depend on a bank, and actually just keep more of what you earn, grow it, and then leverage it. Get in contact with me. I would love to sit down with you, learn more about your business plan. And speaking of business plans, we got to talk a little bit more about that. What do banks do? How do banks work? You see, Henry Ford, he said, it is well enough that people of the nation do not understand our banking and monetary system because if they did, there will be a revolution before tomorrow morning. See, Henry Ford said that. The trap of keeping your money in the bank. Let me ask you something. You ever wondered how much interest your savings account actually earns at the bank? You ever think about that? You might probably think it's like, maybe a few percent, right? Think again. Even the top banks out there, like Citibank, they pay very low interest rates. Yeah, some banks might give a little bit higher interest rate, but they're not that great. Most banks give you 0.001%. Because here's the thing, if your money is only growing at, let's say, 4%, right? But the inflation rate is 7%, you're actually losing purchasing power over time. And it might feel like you're saving for a rainy day, but really you're just letting your money lose value year after year after year. In fact, you might actually might be better spending that money today instead of keeping it in the bank. That's why savers are losers. They're not making any money. Your money should be growing faster than the rate of inflation. At the end of the day, you guys, banks are just like parking spots for your money. They're not really designed to help you make money. So next time you guys thinking about putting your hard-earned dollars into a savings account, make sure you understand a little bit about what you're getting yourself into. And also, banks can actually create money. I know that sounds hella crazy, right? But check this out. The Federal Reserve is the only institution that can actually physically print dollars, and every bank has the power to create money to a certain extent. Let's say you deposit your money into your bank account. The bank's not going to just let it sit there. Nah, they want to make some money off of it. So they lend your money out to someone who wants to buy a car, a house, and they charge them interest. And guess what? That interest rate is a lot higher than what the bank pays you. It's not fair, right? And you're probably thinking, okay, well, how do the bank lend out your money and still let you think that it's in their account, it's in your account? Well, this is something called the fractional reserve. Fractional reserve. Banks are only required to keep a fraction of the deposits in reserve, usually around 10%, and they can lend out the rest. So for every $1,000 that you deposit, the bank can create another $900 out of thin air and lend it out. And that means the total amount of money in circulation is increased to $1,900, and the bank created $900 of it. That's crazy, right? But it's all just digits on a computer screen, so it's really not that difficult for them to do. See, when you borrow from banks and investing into profitable ventures like assets, that's a smart way to do. So back in July 2012, Mark Zuckerberg, yeah, I know the guy that founded Facebook, right? He actually splashed out nearly $6 million on a sweet pad just 3 miles away from his workplace. But get this, he didn't pay for his house in cash. Nope. He got a 30-year mortgage instead. I mean, why would a guy Mark Zuckerberg, he's worth billions. Why would he bother with a mortgage? Why didn't he just pay the whole thing off? You know what I'm saying? He could have just bought his mansion outright. Well, the answer is really, really simple. It's free money. That's right. You heard it right. It's free money. But you're probably thinking, who in their right mind would give a billionaire free money? That's crazy. But check this out. It all comes down to interest rates. Basically, if the interest rate on a loan is lower than the inflation rate, then the money you borrow is technically free. That's exactly what happened with Mark Zuckerberg's mortgage. His interest rate was just over 1%, while inflation was around 2 to 3%. So he's basically profiting just by borrowing money. Is that crazy? I know that sounds like way too good to be true, but here's how it works. Let's say you borrow $1 million at a rate of 1%. The average rate of return on a savings account is 2.4%. So if you stick that $1 million in the bank, and you'll make $24,000 a year. But the payment on your loan is only $10,000. So which means you're actually making a profit of $14,000 a year just by borrowing money. And that's just a drop in a bucket compared to what you could do with $100 million or even $1 billion. And of course, this strategy only works with large sums of money. But when you're dealing with that kind of cash, I'm telling you, even a 0.5% difference in interest rate can mean tens of thousands of dollars. So why tie up your own money when you can use someone else's money for free? The no brainer, right? Not crazy? So the more money you have, the less you have to pay in interest. Banks, they're not operating a charity, right? They're businesses and they're all about making money. And they got people to answer to. They got shareholders who wants to see their profits. So if a bank's not making money, it's not going to stick around. And that's why there's a lot of bank failures right now. The bank crisis. And that's why they tend to feel more comfortable lending money to people who already have a lot of it. I mean, if you're a billionaire, for example, the bank isn't going to lose any sleep over giving you a loan, right? They know you got the resources to pay it back because you know how to build something. And even if something goes wrong, like they know how to get collateral. They know how to make. They know that know how to make ends meet. But if you're living paycheck to paycheck and you're taking out a loan, it's a pretty big risk for the bank, and that's why they're not in the business of taking risk at all. So you guys, banks are very smart. They know what to do with your money, and you got to see things from their perspective. Just like this, imagine if you had a friend who needed to borrow some money. Would you feel more comfortable lending to the friend who has a steady job and a good income, or the friend who's struggling to get by? Right? It's not an easy decision. But banks are trying to be careful with their money right now. That's why there's credit crunch, and that's why they're tightening up the credit flow. So if you guys want to invest like a bank, you have to learn how to grow your money like a bank. You see, credit cards, wow. Let's talk about credit cards for a second. Did you know that 70% of Americans with credit card debt, they won't be able to pay it off this year? That's a lot of people stuck in a sticky financial situation. Think about it. Credit card debt is not like your mortgage where you pay a small percentage every year. With credit cards, interest rate can be as high as 20%. So if you're struggling to make payments now, it's going to get worse as the debt keeps growing. So half of these people that they're like in credit card debt, man, they have no plan, no way of getting out of debt. And what really sucks is that in the next few years, it's going to get crazier because of tightening of the uh, the credit. So banks love it when people fall into debt because they make a fortune off the interest. But every time they send you some new shiny credit card offers, decline it or just figure out another way. Don't let yourself fall into the debt trap because you gotta learn how to live within your means and only buy what you can afford. You guys, how to do so? You gotta learn how to have a financial roadmap. Plan a financial roadmap. See, a lot of people they get to success by planning, right? So, a good financial plan is a crucial step for your financial security and stability. You have to keep this in mind. A well crafted plan can actually help you reach your goals, like paying off debt, saving for a down payment on a house, or saving for your kids' college education, investing for retirement, or anything else that's super important to you. It's easier to start growing your money over time because time, ready return, and contributions will determine your net worth. See, the main steps of actually creating a really good financial plan is this. Number one, articulate your financial goals. So if you want to plan to succeed in getting from here to there, from point A to point B, you have to know what there is. You know, what does success looks like? And this requires you to identify your financial goals. What do you want to achieve in the short, medium, and long term? And this usually includes probably paying off debt, buying a house, or saving for college or retirement. Number two, assess your current financial situation. To get from here to there, you have to have a solid idea of what here is. So by assessing your current situation, your financial situation, with your current net worth, your income, your expenses, your debt situation, and this pretty much is a starting point. And it helps you see the difference between where you're at now and where you want to go. You have to identify these things and what do you need to overcome in order to get to plan B, get to there, right? Number three is to create a budget. Now that you know where here is and where there is, you need to have a map from the former to the latter, right? That's what a budget is. The right budget helps you see the difference between where your money's going now versus where it should be going, and highlighting what adjustments that you need to make to achieve your financial goals. So make sure to include everything, all your income, your expenses, irregular ones, regular ones, and be realistic about your spending. And also make a plan to reduce your high interest debt. High interest debt can be a freaking huge barrier to helping you achieve financial security. Make a plan to pay off any debt as quickly as possible using different methods: the avalanche, snowball, the avalanche method, snowball method, and snowflake method. That's one of it too. So pay off your high interest debt and improve your credit score. Also, start saving for emergency funds. Plan to save for emergency because life is unpredictable, right? It's usually a question of when, not if. An emergency can happen at any time. So set aside a portion of your income to create an emergency fund to cover unexpected expenses. Now, filling a cavity or repairing your car or some type of like weird out of the blue expense, that's not really emergency. You know what I'm saying? Losing your job or having a major medical issue, that's an emergency. Also, you have to plan for your retirement. One day you will get old. You have to plan for your future self. I mean, even if you love your work and you plan to stay working forever, that's cool. But reaching financial freedom is an important goal. And this is the point where you no longer need to need income from work. You can work only on things that you can enjoy. You don't have to go to work, right? You get to go to work. So to avoid having to square away like every single dollar you need, you want to invest your money so it's growing and working as hard as you do. Your money should be working 24/7, even when you're sleeping, because it doesn't get tired. It doesn't need food. It doesn't get doesn't need to rest and take vacations. So start looking into things. Diversify your investment options. Everything from IRAs, 401ks, even cash value life insurance. I can teach you how to grow money in a certain privatized bank account and actually leverage that and use it as collateral to invest into other assets. DM me, hit me up. We can definitely talk about that. Most importantly, work with someone like an advisor, a strategist, a financial planner, and adjust and review as you go along. You guys, planning something, you have to really just take a look back at it and see where you went wrong, where you went right, and double down on the things that you did right, right? And review it because life changes all the time. If you created something, you always have to go back and continue looking at. That's how a financial plan is. But this is a very simple concept of it, you guys. And if you want to get more information, uh, comment, like, share this video. Let me know how else I can serve you because I love talking about money. I love seeing people succeed. I love people putting in a better financial situation. I love to have a moment with you and talk more about this, man. So that being said, I hope you guys, stay blessed, stay intelligent, stay gifted, keep doing it. Be Jeezy. I hope you guys enjoyed this video. In the meantime, yeah, do it big. Arra.